we recommend a recommendation on Rock 10 Corporation with a buy at a target price of $80.14 a share. We believe our target price is supported by the following. First of all, a substantial business transformation. Second, a solid financial position with strong earnings and free cash flow growth. Third, an attractive valuation. Fourth, an industry that favors consolidation. And finally, the mitigation of most of the risk factors.
Headquartered in Norcross, Georgia, Rock 10 is focused on low-cost paperboard and packaging products and services that deliver value to their customers, employees, and investors. Currently, they operate 213 operating facilities, employ approximately 26,000 people, and operate 3 distinct business segments. The company's corrugated packaging segment consists of containerboard mills and corrugated conversion operations. The company's consumer packaging segment is the second largest producer of folding cartons in North America and the largest producer of merchandising displays in North America. And finally, the company's recycling segment is one of the largest paper recycling operations in North America and is a key source of recycled fiber for the company's corrugated and consumer packaging segments. Now, historically, Rock 10 has been known as a profitable consumer packaging company. However, the recent acquisition of Smurfit Stone transformed the company into the second largest containerboard and corrugated packaging company in North America. We believe that this acquisition and business transformation benefits Rock 10 several ways. First, the mill system created through the acquisition complements Rock 10's existing well-positioned and profitable legacy business, provides opportunities for cost improvements and efficiency enhancements. Second, the move to corrugated packaging effectively shifts the company's input mix away from recycled to virgin fiber, which historically is a more stable input cost. North American fiber costs are low and capacity high relative to the global market, which we feel creates a strategic advantage. And finally, Rock 10's management has a history of successfully creating value through acquisition. Since 1997, the company has completed 8 acquisitions totaling approximately $5.7 billion. Prior to Rock 10, the 2 largest acquisitions were Gulf States in 2005 and Southern Container in 2008. Both of these acquisitions delivered synergies in excess of stated targets, and during this time, the company was able to improve earnings even when industry demand was relatively flat. Finally, the $325 million run rate in synergy and performance improvements as of first quarter of 2013 gives us confidence that Rock 10's management has and will continue to deliver value through the Smurfit acquisition, and we feel that the company's target of $550 million in synergies performances will be delivered. However, not only do we feel that the business transformation because of the acquisition benefits Rock 10, we believe that their financial position supports our buy recommendation as the company continues to aggressively pay down debt while returning capital to shareholders through dividends and share repurchases. We also believe that the recent 10-cent increase in the company's dividend reflects management's confidence in its financial position. The company's corporate debt is currently considered investment grade, and given the favorable debt markets, Rock 10 would be able to refinance, extend maturities, or issue new debt. The company has also set a management goal of reducing the leverage ratio to less than 2 times by 2014, and given the company's history of successfully deleveraging following acquisitions and their disciplined management team, we believe this target will be achieved. And then finally, the company utilizes a credit and an accounts receivable financing facility, which essentially improves the company's liquidity and provides a reliable cash stream the company can draw upon and pay back as needed. As of December 31st, the company had approximately $1.2 billion of liquidity available.
After examining their financial position and a substantial business transformation, we turned our attention to the valuation model. Now, in setting our price target at $80.14, we used a discounted cash flow model with a terminal EBITDA multiple. Historically, Rock 10 has maintained an average EBITDA multiple of roughly 6.5 times. However, to account for varying economic conditions, we used a range of multiples from 5.5 times to 7.5 times. We also included the projected industry growth rate of 3% into our discounted cash flow model. We also closely examined Rock 10's projected earnings and free cash flow growth, which remain very strong, and that is for 3 main reasons. First of all, as just mentioned, the projected industry growth rate of 3%. Second of all, the containerboard industry recently passed a $50 a ton price increase. Now, this was not originally priced into the stock, as many analysts believed that they would only meet $20 to $25 of that $50 price increase. However, they have met at least $40, and that only adds to their earnings potential, and we believe that is more fairly valued into the stock. And for the third reason, cost reductions. Rock 10 has experienced substantial cost reductions, both from the Smurfit Stone acquisition and from low input costs. Also included in that is their recent CapEx forecast, which is forecasted to fall from $550 million to $350 million, which only adds to their free cash flow. And finally, to add icing on the cake, first quarter earnings were just released. Adjusted earnings rose 14%, and free cash flow a share rose from $7 to $7.99 a share.
While strong earnings and cash flows make Rock 10 a solid buy position, the industry consolidation has also boosted Rock 10's position. In recent years, the U.S. containerboard industry has become extremely consolidated. In 2003, the top four players accounted for more than 64% of the market share. Today, the top four players account for more than 72% of the total market share. The industry has become, in this competitive global environment, it is important for a company to be a low-cost producer and also to keep both input and inventory costs low. The industry has shown supply-side discipline. Both operating rates and capacity utilization levels remain high. Additionally, the inventory levels are at 3.6 weeks. Among the global competitors, North America leads the way by being a low-cost producer. The industry containerboard price is $304 per ton. Rock 10 is a leader among the North American segment by having its containerboard price well below the industry average. Rock 10's containerboard price is $292 per ton. For the first quarter of 2003, both the industry and Rock 10 showed favorable results. Corrugated packaging volumes were up 1.3%, and Rock 10's domestic box volumes were up 3.2%. Rock 10 exported more than 300,000 containerboard, and corrugated packaging accounted for more than 15% of EBITDA.
While Rock 10 has certainly been aided by industry consolidation, the risk factors are no great hindrance. The Smurfit Stone acquisition cost more and took longer than many analysts expected. However, Rock 10 has a strong management team that have integrated many mills in the past. With the Smurfit Stone acquisition, Rock 10 acquired a $1.4 billion pension liability. However, contributions for this liability have been decreased vis-a-vis pension funding legislation. The $50 a ton increase in price, as we stated, is sticking to $40 a ton instead of analysts predicted $20 to $25 a ton. As you can see, despite uncertain economic futures, box shipments remain strong, or projected box shipments remain strong thereof. And commodity pricing, although erratic in the past, seems to be stabilizing currently and in the future. Even with the risk, Rock 10 appears to be and still is a solid buy.
And just to reiterate, we believe Rock 10 is a solid buy based on, once again, the substantial business transformation, the solid financial position with both strong earnings and free cash flow growth, the attractive valuation, the industry consolidation that favors Rock 10, and the mitigation of most of their risk factors. Now, when first developing our report, Rock 10 was at roughly a $60 a share company. When we turned in the report on the 16th, it is a $72 company. However, after the recent earnings release, it is now an $80 company and above. So we believe that we have achieved that outvalue, and that is much more fairly valued stock at the moment. Thank you very much, and we will now take any questions you might have.
I had a question. You applauded their move to they're going more toward virgin fiber, I think you called it, instead
Yes,
of
sir.
recycled. How do those costs compare?
Overall, the
Yeah.
cost for virgin fiber is significantly reduced to that of recycled fiber, and Josh can elaborate.
Yeah. Also, management has indicated that their fiber mix is going forward approximately 55% virgin, 45% recycled, and they continue to reiterate that the low cost of the fiber gives them a low cost advantage in the industry because historically it is a more stable input cost where recycled fiber costs tend to be a little bit more volatile. So by shifting their mix to more fiber heavy, they feel that they have a lower, more stable cost input that they can leverage going forward.
How flexible is that plant-based then if they're 50% recycled and 50% virgin? Do they have the opportunity when prices change to utilize, certain plants more than others and shifting around?
That I don't know off the top of my head. I'd be happy to find that out and respond back to you.
The reason I ask is just because you had said that the fiber is more volatile, so I'm guessing there are times when fiber historically has been a cost advantage.
I would assume that they would have the flexibility to do that if necessary, but I can't factually state that.
And one quick follow-up. I saw there's a slide that showed that North American costs were a lot lower. Do you have a sense for why that is?
It's because that the North American segment uses a higher percentage of virgin fiber over the recycled mix. Because as what Josh had just stated, the recycled mix is more volatile in pricing.
Okay, that's for companies.
Yes, but in general, the North American segment uses more of a virgin fiber, a higher percentage of virgin fiber over the recycled mix. So that's why the industry as a whole has a lower price point than the other industries where they use a higher recycled.
So the
mix.
other geographies use higher recycled
Exactly.
content? Okay. That just happens to do with forests and geography?
Exactly. In the South, we have an abundance of pine, which helps the industry as a whole.
You had a chart on the growth of boxes or
That
yeah. So where did that come from, and how confident are you or of that playing out?
Again, it's a forecast. You see our sources, AFPA and RISI. It's a forecast. With all forecasts, it's an educated guess at best. But the point I would reiterate is, even if we do not see 3% growth in box sales, Rock 10 has shown in the past they can grow their earnings even when industry demand is flat. So we are confident, even if we don't see this 3%, say if it's 1 or 2%, that you're still going to see a positive lift in earnings in the company.
And also, I just want to reiterate, both the industry and Rock 10 had increase in volumes. So that also kind of
So
is that.
do you have a sense for what the major drivers of box shipments are beyond just GDP growth? Is it specific industries? Or?
Well, I know that Rock 10's corrugated packaging segment is basically food and beverage and consumer non-durable heavy. And then their consumer packaging segment is essentially food and beverage and consumer discretionary heavy. So those would be the two drivers, especially since a large majority of their packaging is responsible for food and beverage.
The pension slide, the change in legislation allowed for it. Tell me about it.
Well, on July 6th of this past year, 2012, President Obama passed and signed into bill legislation that reduced the contributions for it. Prior to that, all of the contributions were factoring in interest rates for the past 2 years, whereas the new legislation factored in average interest rates of the last 25 years. So contributions were reduced because they didn't have to worry about as low interest rates as they do now.
What do you think about that?
Overall, I think it's a better plan because, quite frankly, the interest rates right now are somewhat unrealistic for the future in terms of, I don't see the interest rates right now being applicable for the next 30 years. Whereas I think the average for the past 25 years is much more applicable.
What are you looking for the next data point, say a year from now? What would you be looking at to confirm or make you change your mind?
To go back to our valuation model, I'd say we'd look at free cash flow per share. That was the strongest input into our valuation model. So if I had to choose one data point to look at a year from now, I'd probably examine their free cash flow per share and just confirm that it has reached a level we thought it would or a similar level.
To continue on his thought, I would also like to know if the entire $50 price increase sticks, because as we've discussed, originally analysts were thinking 20 to 25 was going to stick. Rock 10 indicated on the recent earnings conference call that 40 to 41 is stuck, and they're confident that it's going to get to $50. So I would like to see in the near term whether or not that actually happens.
So on evaluation, I believe you only use free cash flow? That was a,
John?
Yes, sir. We use free cash flow, however, to also just account for an unstable market. We also use a terminal EBITDA multiple. And that's just to, of course, account for different market conditions and different economic conditions and different price levels that might be traded at.
was there a particular reason you chose not to do a multiples-based analysis?
Multiple-based analysis, we believe that this more fairly valued them strictly because they are a cash flow generating company. It's a commodity business, and they're focused very strongly on cutting those costs and getting that free cash flow out. And as mentioned before, they've increased their dividends the past 3 years in a row, multiple times. So we thought that strictly based on that this kind of cash flow valuation would be more applicable to the company.
What do you think of the Samford acquisition? Is that a smart move?
I think it's a gutsy move, because essentially they took a company that took a nosedive because of debt, took on all their assets in an industry where some analysts would argue it's not high growth, but management went in, and just go back and reiterate on my management discussion real quick. If you look at Rock 10's management, they're very smart in their acquisitions. They seem to pick acquisitions that create value for the company. So I'm confident that the move was smart, or else they would not have done it, because history suggests they make smart business moves.
And it also transforms their business segment and transporting them to more of a corrugated packaging company, which I think was a smart move. If you go back to that slide, you know what I'm talking about?
This one?
No, the one before.
Okay.
The one where the business segment, where it shows the change in the front.
I'll let you drive the car.
1 minute.
This one. This is what I'm talking about, how it's changed that business segment, which I think is a smart move.
What are the relative profitability of those different segments?
That off the top of my head, I do not know.
Corrugated packaging by far is one of their leading segments.
I know that from a net income level, now that I think about it, consumer packaging is the sales closely mirror what their income is. I mean, it's basically around 50%, but we're seeing a growth in the corrugated packaging because, of course, their business has shifted to more corrugated heavy, but to be able to give you an actual number off the top of my head, I cannot.
And it's an improving industry as well.
And it accounted for 15.4% of the EBITDA as of the first quarter of 2013.
Thanks.
Thank you.
So much.
Probably